Let's turn now to the small cap trade. A lot of talk among strategists this year about the potential rotation into small caps as the Fed was set to begin their rate cutting cycle. We even saw the Russell 2000 briefly outperforming the S&P 500 in August. Small caps got a boost after President-elect Donald Trump won in November as well. So what can we expect from the trade in the new year? Joining us to discuss, we've got Brian Vendig. He is the Chief Investment Officer at MJP Wealth Advisors. Brian, great to have you on here. This small cap trade, we have been waiting and waiting and waiting for the catch up in these small cap names. Is 2025 going to finally be the year?
Great to see you, Madison. Good morning. I really hope so, because when we think about the policy decisions that are out there in the future, they're there to support the economy and also the Fed still keeping the door open for rate cuts. And I think in the short term, those policy puzzle pieces has definitely cast a doubt on the small cap trade, recognizing that this past month has actually been, I think, the worst month on record going back to the fall of 22. But when you look at small caps over the last 10 years and that significant underperformance as compared to large cap peers, I still think it's something that investors should think about from a diversification point of view. And also considering that when Trump won back in November, we saw a huge boost to the small cap market. Didn't take much to catalyze the sector. So our view is that as long as the economy stays on stable footing and some of these policy decisions don't go to extremes, and obviously a little cooperation from the Fed, that could be the perfect combination to see small cap outperformance in 2025.
So Brian, when you talk about the policies, it's important for policies not to go to the extremes. It's important for the Fed to cooperate just a bit. I guess more specifically, what does that look like?
Yeah, Shauna, so that's a great point. So just to drill in, I mean, right now when you look at the bond market, for example, it has priced in that there will be 0 rate cuts next year. And I recognize that since December 18th, we've seen this pullback in the market due to Fed speech and also from the realization that with Trump 2.0 coming to town, we don't know what's going to happen with the extent of immigration reforms. We don't know exactly how Congress is going to behave regarding tax policy changes or maintaining the existing 2018 tax cuts past the end of 2025. And we also don't know the extent of restraint that might exist with fiscal spending, which is supportive of the economy in the short term. So those types of puzzle pieces, Shauna, is what's casting down and why we're seeing the market pulling back, I think, towards the second half of December. Also, the Fed adding a little catalyst to that uncertainty regarding policy measures. But at the end of the day, just to crystallize all that, I think the market's going to come back to earnings. So first couple of months next year, first half of next year, easy to say choppy market due to those policy issues. But if earnings continues to stay intact, earnings growth year over year, 10% growth there, we're still constructive on stocks. And we also think bonds might be an opportunity as well, considering where yields have come so fast, so quick since the last couple months of the year.
So what trade does that initiate, those puzzle pieces? Some of the sources we've spoken with have said that could lead to more of a rush into tech as a safe haven, but others say that tech becomes even more risky in that backdrop. What do you think?
Well, Madison, I'm definitely at the point where when you consider how much tech is a big part of the market cap weighted indices these days and where investors have gravitated to, I'm definitely not one to recommend to add to mega cap tech at this point. But I think taking a look at some of those value-oriented sectors that help to play into innovation and growth for the economy still makes sense. And so areas such as the industrial sector, when you're thinking about innovation around infrastructure, electric grid enhancement, power generation, but also like innovation in the biotech area and also some of the large pharma space as well to play a little offense and defense. And as I said before, if you look at things from a valuation and a forward-looking perspective, mid-cap and small-cap stocks are more fairly attractive than large, and we're still allocated there accordingly. But I think you really need to come back to that point of broad diversification in this type of market environment and making sure that you're not overpaying for growth from some of the winners of this past year is what really makes a lot of sense as we move into next year. And as much as bonds have gotten beaten up in the short term, I think investors have a chance to look at those bond yields and say, hey, well, those are a little higher than just traditional cash money market than when we were before. And if we get a little bit of a pause in the economy or we get some uncertainty, we've seen normalization of behavior of investors going back and buying into fixed income. And I think that might be an opportunity for investors as well over the next 12 months.
Brian, we just had pending home sales numbers out this morning showing an uptick here on a month-over-month basis. When you compare that to year-over-year basis, there seems to be some optimism within the release, just talking about some of the activity that we could see within the housing sector, pairing that with the housing starts number that we got not too long ago, where we did see a bit of a move here to the upside. Is that an attractive investment opportunity? Why or why not? And where should investors be looking?
Well, I definitely think there's areas, Sean, as you mentioned, where housing could be an attractive sector if you get a cooperation on Fed policy regarding rates. At the same point in time, I think when you look at the labor market and you look at the stability of the labor market, even though the labor market might show some signs of slowing next year, Americans feel comfortable in spending and looking at some of these bigger ticket items when they feel confident that they have a job. And I think, when it comes to housing, infrastructure, some of these cyclical oriented sectors, they're having a little bit of a tough time over the sense of this quarter due to those policy uncertainties. But I think as more and more information comes out from our friends in Washington and also the Fed, I think these might be opportunities for upside potential over the balance of the second half of next year.
All right, Brian, thanks so much for taking the time to join us here this morning.
Thank you.